but then it's okay, right? There are good number of participants, but I think that number of participants is low. So we are recording this particular session. So the idea for this session was to discuss with stock and mutual fund investors that what has to be done in their stock and mutual fund portfolio right now in the current market situations. So this was the whole topic which we wanted to discuss. We will take somewhere around 20 odd minutes to discuss few things, and I hope that it will be beneficial for all the ultra HNI clients whom we are targeting. So let's start the discussion. Basically, we as an investment advisor have three major products, two major products in stock and one for mutual funds. On the side of stocks, we advise two portfolios, one for 365 days and one for 90 days. Basically, what we do is that we do a lot of data crunching. We analyze local and global macros, and then we use technical analysis to analyze the entry and exit point for our stocks. And we make a stock portfolio of 12 to 15 stocks, and then this is a dynamic portfolio. It keeps changing depending upon market situations and the stocks condition. And what we do is that we try to look for a return of some 12 to 15% in 90 days portfolio, and return of some 50 to 60% in 365 days portfolio. Soon we are launching a 3 years portfolio also, in which we will be looking at a return of 150 to 180 odd percent. We make similar portfolio for mutual fund also, which remains for 3 years. And for this 3 years portfolio, the important thing is that we keep churning the mutual fund portfolio. Obviously, a lot of macroeconomic dynamic changes for local and global on local and global front. So we keep changing our portfolio depending upon the macroeconomics. So this is how we manage wealth management for our clients. All the product details are mentioned on our website, so you can do, and you can go to our website and have a look at that. What we do is that in fundamental analysis, we use top down and bottom approach of investing, depending upon the market situation, and we use technical analysis to time our entry and exit. For ultra HNI clients, I would like to say one thing, that what is fundamental analysis and what is technical analysis, we will not. I'll try to not go into jargons in this discussion so that things are simple. But for example, we are in a mall and we want to go. We are on the ground floor. We want to go on the first floor. So we look at the escalator. So when we shortlist the escalator, that which escalator will take me from ground floor to first floor, that is the work which is being done by fundamental analysis actually. So we analyze the stock first. This is the fundamentals of the stock. In our top-down approach, we analyze the economics, then we analyze the sector, then we look at the stock. In bottom approach of investment, we look at the stocks who are doing really well. And then we use technical analysis to see that where should I stand on that escalator and where should I exit from that escalator to ensure that I reach on the first floor. So this is what is the use of fundamental and technical analysis in our advisory. I will discuss one stock which we advised few days back. I advised on 23rd of March to buy Bajaj Finance at 2350 odd rupees. And on Friday, 27th of March, we exited at a 25% profit at a price of 2880. Now, ultra HNI clients don't want to exit. They don't like churning in their portfolios. Okay, and this is obviously a habit which has been inculcated since long. But I would like to tell everyone that this is very harmful habit for investors. If you look at Mahabharat, then there was a character called Abhimanyu. Now Abhimanyu knew that when to enter the Chakryu, but he didn't know that how to come out of that Chakryu. So that is why he was penalized. Similarly, for investors, also the same thing happens. If you are entering a stock, then you should know when to sell the stock. If you don't know, or if your advisor doesn't know when to sell the stock, accident is bound to happen. We bought Bajaj Finance on 23rd of March, and what we did was that on 27th of March, when there was a resistance at 2950 to 3030, we sold the stock and we exited with a good profit. But most of the times it doesn't happen with ultra HNI clients. They do not exit out of their investments, whether they are in profit or huge profit. They do not exit out their investments. They think that they can maintain that portfolio till eternity and profit will keep coming. This thing doesn't happen. As the global markets come under pressure, a strict sell rule is what can protect you from emotional and financial stress. So often, when the market is in a correction, three out of four stocks follow the market direction only. So they are bound to fall. Consider a simple maths. Say, for example, somebody buys Bajaj Finance at 3,000 on Friday only when it was trading at 3,000. Now, immediately drops to 2880 after some time. So, and you sell it. Then you say that there's a resistance, you sell it. So you are in 4% loss, right? Now your money is down by 4%. So you actually, for buying a stock at 2880 and to make it reach at 3000, you need only a return of 4.16% to recuperate your loss. But majorly what happens, somebody must have bought on Friday Bajaj Finance at 3000 rupees and he must be holding it maybe. So what will happen is that he must be thinking, I'm buying at 3000. Earlier the stock had gone up to 4800. Let me stick to the stock, right? What will happen? He has bought at 3000. At some point of time, it will come at 2300, where we actually bought, right? We booked the profit of 25% for our clients in our portfolio. So it will come back to 2300. The loss will be 25%. But for recuperating the loss, he will have to gain 31% in a different stock on the same stock to recuperate the same loss. While earlier it was 4.16% only. Similarly, Bernstein has downgraded Bajaj Finance. There's a global agency, Bernstein, they have downgraded Bajaj Finance. So they have given a stock target price of 1700. So for example, it comes to 1500. So the guy who bought at 3000, he has a loss of good 50%. So he will think, boss, my banker, who is a wealth manager, who has told me let's not get out of this stock. So I can let me stay in this stock at 1500 rupees. But now, please calculate, to make a stock of 1500, to invest a stock of 1500 and let it go up to 3000, you need a 100% return. So how many stocks did you pick last year that doubled in price? Name one stock which has doubled in price. Same problem has hit all the investors now. Most stocks are 40% or down. So to recuperate that stock portfolio or mutual fund portfolio, you need 100% return, right? So this is very important that whenever there's a sell-off in market, you need to exit. You need to book losses, right? Obviously, it has to be done by an expert. An ultra HNI client or retail client cannot do it. It has to be obviously done by a expert only. So how to know that there is a market slowdown and when to sell your position? This is very important, right? So the important thing is that you have to time the market. Please pick up a right advisor, right analyst who can analyze the markets in a better way. Now, for example, a very basic example is that whenever the sectoral indices are trading below their 50-day mark, 50-day exponential moving average, indicating gross based weakness, you have to sell your stocks. Please don't get confused by this dema. Simple thing is that I scored average 50% marks from my class nursery to class 12th. Right now, my kid scores one day, he scores 35%. So I should be worried because my average from nursery to 12th was 50%, but he has scored 35%. It means he's going below my average. It means that there's a recession, right? Getting the point? So simple point is that, and in the mathematical terms, This is called a exponential moving average. Simple, it shows a broad-based weakness. So, for example, if you are our what we did with our clients, we continuously discuss in January also that 12,200, 12,370 is the resistance. Let's not buy. On 29th of February at 890, we said that 10,000 is the level. Please don't buy, right? Or book your losses or wherever you are. On 6th of March, we discussed that 8,500, 8,550 is the target, right? When Nifty was trading as 10,000, and said that 7740 is the downside risk, which is right there on the videos which we shared. And 7740 also hit, and it has gone up. Now, during the market pullback, we, Sharad Mission Associates, try very hard to make a list of stocks that held up best, which haven't actually fallen. So we focus on the local and global macroeconomics and sectoral and stock specific analysis and find most resilient names with the least amount of technical damage, right? So basically, we analyze a lot of global and local macroeconomics, and we see that which all stocks haven't fallen that much. In current lockdown, there are some 45% of the economics is open. Rest 75% is closed. So what is that 25% economics which is open? It is FMCG, right? It is your some sort of pharma, right? It is your telecom. So there are certain sectors which are working well. Okay, and then if you look at our portfolio, what did we do? We have advised to our clients lately on 23rd of March, and our portfolio is decently up by somewhere around 10% in less 4, 5, 6 days. I do not say that this is going to be up by 10% in till eternity. Obviously, down the line when I'll discuss few more things, I'll discuss the fundamentals of the local and global. When we'll discuss the local and global macroeconomics, we will discuss that what is the risk. But what did we do? We bought certain good stocks at very good prices. We bought Infosys at 532. We bought ICICI at 287. We bought HDFC Bank at 779. We bought Titan at 822 rupees. We bought Bata at 1071. So we did good bottom picking, which is being done by institutions only. So what we are doing is that we are continuously working here to ensure that our clients get best of the picks. We are regularly advising good mutual funds also, which can be bought into, right? So this is what we do. Now, since we are here to discuss that what should be done by the stock investors and mutual fund investors who are in loss, let me first discuss the fundamentals of the economics, the local macroeconomics and the global macroeconomics. Then we will look at certain technical indicators. Then we'll zero in on the strategy, that what has to be done, right? So the problem currently is that uh, last 5 years the SIP returns have become zero, right? There is a virus attack in the world. So who knows that there will not be another virus attack in the world few years down the line, right? Globally, there is a war kind of situation. So I'm addressing ultra HNIs. Please, how can you be rest assured that your mutual funds and stocks will grow like fixed deposits year by year at the rate of 10, 12%, 5, 6, 7, 8%? It's not possible, right? So you need to be highly vigilant with your investor advisors that they should advise you the right thing at the right time. So now discussing the macroeconomics, the problem is that we are in a kind of uncharted territory. Now this is kind of jargon which is being used across. So what is the meaning? Uncharted means we have never witnessed this kind of fall ever. We have never witnessed this kind of situation ever. So we do not know that actually what's going to happen next. We simply do not know. So this is the major problem. Okay. Now I hope I'm visible now. I'm sorry I could not, just forgot to open my camera. So the point is that there's a total lockdown which has happened, which has pushed the economy into an uncharted territory. So, but there are certain stock sectors in India which are exempt from the lockdown, including food, pharmaceutical industries, storage, telecom, right? Electricity department, banking, capital market, etc. Now we estimate that these sectors comprise roughly 25% of the economy only. Current guidelines will lead to a complete halt in activity. The complete activity is halted actually. And 75% of the economy is closed. And looking at China and Italy, we think that it will remain closed for a month or so at least, right? On average, every month of lockdown is resulting into output decrease of 8.5%. What does that output means? That if we look at diesel consumption, direct tax collection, right, which government does, visitors arrival, electricity generation, medium and heavy commercial vehicle sales, passenger vehicle sales, aviation passenger traffic, railway passenger traffic, then it is completely halted, right? So 75% of the economy is closed. And if we look at 75, 8.5% of 75%, it means that the total output which the country does, India does in a year, 6.5% of that is closed, right? So what will be the effect of that? The effect will be huge. The effect will be that you will see that in fourth quarter of financial year 20, means January, February, March of 2020, the GDP growth will be negative, right, will not grow at all. So the financial year 1920 GDP expectation, which was 5.8%, will come down to somewhere around 2.5%, right? And then the problem is that we are in an uncharted territory. We have not seen that. We do not know that when the markets will open, when this economy will open, when the lockdown will open, what would be the situation? What is the effect everywhere? People are fleeing from the cities, right? They are going to the villages, right? So what will be the effect, altogether effect on the economy? Only agriculture is one sector which is going to pump the economy. And there are certain 25% of the sectors which I have discussed are working currently. So, what is the problem? But we have anticipated pretty early. We, Sharad Mission Associates, have anticipated pretty early that this GDP fall of the financial year 1920 GDP of some 2.5% is already discounted in prices, right? We are trading around 7750, 7500 Nifty levels, right? And if you look at the prices, then 6800 was the Nifty price when in 2016, right? And in 2014-16, the price was somewhere around 6200. So 6 years of economic growth we have already discounted in the prices of Nifty, right? So now, if you look at the companies, the Indian corporation, then we will see that the EPS will be a kind of, there will be a double digit reduction in EPS also, earnings per share also for all the companies, right? There will be sharp increase in corporate and banking sector stress, right, which are likely to further weigh on growth. The financial year 21 growth will also be hit. So these are the, I mean, I'm discussing the negatives. I'll discuss the positives also. That how we are going to cope up with all these things. Now, if we look at GDP, then GDP is whichever way hit, tax collection has hit. So we expect that financial year 21 fiscal deficit also to be somewhere around 4.5%. Government has said that it might be somewhere around 3.5%, but obviously it is excessively relying on disinvestment proceeds and dividends from the public sector. So I will tell you one thing here. Now, since lately what government has done is that they have given up a lot of packages. They are doing a lot of expenses. They are taking fiscal measures. Now, fiscal measures are what? When government does a lot of expenses on their own, those are the fiscal measures. So for meeting those expenses, government will disinvest. So there will be some good PSU companies which will be deinvested, wherein there will be disinvestment. So we at Sharad Mission Associates are keeping a watch on those companies also. Those shares will actually run like anything whenever there will be a disinvestment, right? However, whenever there is a pressure on fiscal deficit, the only community which worries a lot is FIIs actually. So they might not come back, they might not put the money. When the market had gone down to 7500 level and bounced back to 8700, we have seen that FIIs haven't participated. They have sold everything, right? However, DIIs, the domestic investors, has actually bought it. It might be LIC, it might be mutual fund companies, they're buying it. Now, another problem which remains is that Rabi crop is about to be got to be done in North India, right? It has to be sown. Now it is sown in July and harvested in October. Majorly barley, wheat, potato, mustard, cotton, millet, etc. Rabi crops. Now, shortage of labor for harvesting and transportation will also be a problem, right? Now, this will also add to the poor GDP numbers of financial year 21. So, this might be a potential risk. We had seen that in North and East India, citizenship amendment bill has been protested. There were a lot of protests. So, there were certain disruption which had happened in that part of the country. So, that might also lead to the degrowth in GDP. Okay. Now, the one silver lining is that the global supply chain is definitely going to be shifted from China to other countries. All the global countries have understood that China might be doing unfair practices, right, to increase their foothold in the economy and in the global economy. So it might happen that the supply chain. Now, supply chain is simple. The complete procedure of preparing a product is the supply chain, right? Setting up the factory, setting up the processes and everything. So now India has a very good chance that they can make a right elusive capex cycle, right? What they can do is that they can capitalize, they can do a lot of investments in India, they can create that kind of manufacturing hub, and they will be the first beneficiaries because the overall reputation of the country is very good across the globe. They know that Indians are ethical, right? There's a democracy, right? There's a good government in place, good leaders are in place. So these things are going to help India. But India will have to, government will have to come out. They have to spend like anything. And I'll discuss that. Government is doing a lot of expenditure in that part also. Now, before the COVID-19 breakout, RBI has already told that when they had issued the financial stability report, they had discussed that banks' gross NPA is going to increase, right? It is going to rise from 9.3% to somewhere 10.5% in a severe stress scenario. And that is bound to happen. Not, and we must not be surprised that credit rating agencies have already downgraded a lot of instruments at faster pace, and we are seeing the corporate sector stress. So that is why lately the RBI policy, which was announced, they have taken a lot of steps. We'll discuss all the steps have been taken. So look at the positive things. There are a lot of things to be looked at negatively. Obviously, we are in an uncharted territory. We have not seen that. But with the evolution of the economics, we are heading looking at the future. We must be ready with these sort of things like COVID-19 and all. We don't know that what sort of problems are going to happen in future to come. So, if you look at RBI states, what did they do? They injected huge liquidity. There's some 2.28 lakh crore of liquidity which has been introduced, which is 3.2% of the GDP. Now, I have few days back texted that RBI governor has said that we have taken conventional and unconventional every step. This is more than Bernanke's speech, which was done into last 5-6 years back in US. He has injected money like anything. So this is much more than required. Okay. However, RBI is saying for the first time, RBI has said that we don't have any guidance for the growth rate or the inflation, which is actually leads toward that uncharted territory thing. So they have reduced the repo rate. What is the repo rate reduction means? They have ensured that the EMIs go down and people have more money to increase the consumption, because everything depends upon consumption. The more money you have, the more you buy, the more is the company's profit and more is the economic growth. So they, because of the loss of jobs, they have ensured that people's EMIs are coming down. So they have reduced the repo rates. Now they have reduced the reverse repo rates also. Reverse repo rate decreasing means banks are discouraged to deposit the money with RBI, and so they will have the option to lend it to businesses and ensure that the growth is there. Because banks' primary job should be to lend it to the businesses. However, lately banks are actually depositing money in lakhs of crores with RBI, which was actually bad for growth. Now, RBI has announced a very unique thing, which is basically targeted long-term repos. Now, this is very important to listen from the perspective of mutual fund investors and also stocks Why we have bought ICICI Bank and SDFC Bank at so low prices, right? I'll tell you why I advised those stocks to our clients. Now, what RBI has done is that they have announced targeted long-term repos. What does it mean? The banks can invest into investment grade corporate bonds, commercial papers, and non-convertible debentures. Now, this is a repurchase program by RBI up to for 3 years, up to 1 trillion rupees, means 1 lakh crore rupees. The bank will buy the investment grade corporate bond, commercial paper, non-convertible debentures. Means bank will invest into different companies in their good debt papers. Okay, and that RBI is buying back. So what will happen is that there will be a reduction in yield at the shortest end of the yield curve. Don't go into this jargon. Simple thing is that in short-term commercial papers, the interest rate will come down. So what has happened is that overnight mutual funds, there are overnight mutual funds also because there are overnight repos. Banks take money overnight. So overnight mutual funds, which are different than mutual funds, which are meant for immediate liquidity needs, and they invest into securities but with 1 day maturity. Their yields have come down. So now they are trading somewhere around 4%. This is the cheapest money available in the market, right? For lending it. So what will happen to mutual fund investors where they should be keenly observing is that there are short duration funds and banking and PSU funds, which is basically core debt portfolio. They will gain the most. Now, what banks will do is that they will be looking to buy high quality debt at the short end. It's up to 3 years maturity. I'm talking about up to 3 years maturity, right? And funds such as short duration funds and banking and PSU funds hold these sort of securities. So all the mutual fund investors who can park their funds into short duration and banking and PSU debt funds will gain. So let me tell you, as a wealth advisor, we never advise that you should park your fund into debt funds if you want to grow your money. Ideally, that money which you need over the period of 1 2 years, 3 years, 1 2 years, please park it into debt funds. Else, if you have a horizon of 2 3 years, obviously we have products for 1 year, 1 year. Since we are experts, we manage that kind of risk, right? But on your own, please do not take that risk. So they have reduced the CRR also, cash reserve ratio also. So another 1,37,000 crore rupees of liquidity has come in. Now, what is this liquidity meaning? A lot of liquidity is all around bank discussed in newspapers, TV channel. Liquidity simple means the banks have that money, money is in the system, it is going to the businesses to ensure that they can do more business. They have more funds at cheaper interest rates so that they can produce more, they can sell more. Simple thing, right? Now, what RBI has done as a very good thing. Currently, in lockdown situation, SMEs, MSMEs are actually not working at all. They're only paying salaries to their people. So what they have done is that they have relaxed their repayment pressures, right? So, say for example, you have taken a term loan. There's a 3 month moratorium. It's 3 months you need not pay any kind of EMI. After 3 months, bank will every bank has this leeway that they can decide that when to take back this EMI. If you have a working capital limit, then no interest will be charged. It will be charged up to 3 months only, right? So these sort of things have already been announced by RBI. So it has relaxation has been given to SMEs and MSMEs. What is the benefit? First thing, banks NPA will not increase. Second is that SMEs and MSMEs will also get some time, right? So that they can get back into business. And one thing I would like to tell you that all the ultra HNI investors that see if the GDP growth for financial year 1920 has come down to 2.5%, if we anticipate that first quarter of financial year 21, right, GDP is going to be nowhere. But whenever this lockdown will be removed, okay, be rest assured that there will be huge V-shaped recovery in GDP and stocks will run like anything. Whichever way stocks have made a low at 7,500 Nifty, and we might not see good stocks trading at low levels again, right? So because they have been bought by institutions at the right price. Now they are trading much above their right prices, and the retailers will buy only those prices, and they will have a risk that the stock prices might go down. Because what happens that whenever you have bought a stock, there's an upside pressure also, right? Say for example, I have advised my clients to buy HUL, right? So what will happen is that HUL we have bought at 1900, it had made a low of 1700 someday. right? ICICI we bought at 287, it is trading at around 340, 50 or so, right? Now, there's an overhead supply. There's something called overhead supply. What happens? I bought as ICICI at 287. It is trading at say 350. What will happen is after some point of time it will trade at 380, 400. Now, those people who had earlier at 12,000 Nifty level bought it at somewhere around 400 or so, they will sell it because they want to make their positions break even. So then there will be a fall. But that should not be the opportunity to buy. What will happen to most of your advisors is that when that overhead supply will come, stocks will fall, your advisor will come and say, sir, please buy. That is not an opportunity to buy. If we have to be winners in this market, we have to follow institutions. We have to follow at the same price where institutions have bought. So if stock ICC trades at 400 and sells down and there's a sell off and it comes to 320, who will be in loss? Who has bought at 360, 340? On any advice. However, we have advised at 287, will still be in profit. And then stock will not remain in that sold zone for long. It will again bounce back. So it will again go up to the territory. We are looking at a price of some 440 or so. Okay. So this is one thing which is very important for all the ultra HNI advisors, investors, that please be with the right set of advisors. Markets are difficult. Okay, markets will be difficult in time to come. Okay, and if you have to make money, you have to be ahead of everything. Now let's discuss the COVID-19. Now MIT is an institute in US. What they have analyzed, they have given a very good report. So they have shown that they have analyzed the COVID-19 breakout in US. They have said that the outbreak also shows a north-south divide. Means the northern, which are the cooler states, have much higher growth rate compared to southern, the warmer states. So the spread is limited to Texas, New Mexico, Arizona, right? Now, even in California, which spans a large climatic zone, the number of cases is double the northern part of the state than in the south. So what does it mean? That the areas which are 18 degrees or plus, the look at Africa, look at parts of Asia, basically the kind of growth is not that much. However, if you, I was analyzing few charts of the growth. We from the till 12th day there was a huge exponential growth in numbers in all across all the countries, right? We are least, but let me tell you, up to 30,000 cases in India, market has already discounted at 7,500 Nifty level, right? I'll discuss the right Nifty levels. I'll discuss the right market levels also. But this part has already been discounted. Okay. Now, what the technical analysis shows? Technical analysis shows that FIIs are decreasing their short positions in derivatives. Okay, so they were earlier very short. Now they're decreasing their short positions in derivatives. Now, if we analyze the option chain, then we'll see that there's strong put writing is 8,600 and building up at 9,000, and 9,100 and 9,200 is strong call writing, which is strong resistance zone, right? Some strong resistance is placed as somewhere around 9,100 and 9,200, and strong call writing is there. It means that that is the resistance zone. Okay, I have already discussed regularly that 77, 40, 80 is a very strong support, and on the downside 6767 is a very strong support, right? Now government is doing a lot of steps to increase the cash in the economy. The consumption has fallen because obviously people have lost their jobs. So government announced welfare schemes by the name of Prime Minister Garib Kalyan Yojana, investing some 1.7 lakh crore, giving money to farmers, right, from PM Kisan Yojana. Okay, then giving money to a lot of farmers in the form of different schemes. There are some 20 crore women Jan Dhan accounts. They are giving money to them also, right? EPF, they are contributing extra money, right? For self-help women under Deen Dayal Upadhyaya National Livelihood Mission, they have up to 10 lakh rupees of loan was there. They have increased it to 20 lakhs. Why I'm discussing all these things? Because government is trying to increase the money in the wallet of the people so that they can spend. The more they will spend, the more will be the per capita income. The more they will spend, better will be the growth in the economy. right? The government is taking all sort of steps. And one more, I must say, stimulus is about to be announced by government very soon for helping the industry as such. Okay, so now looking at both technicals and fundamentals, what is the advice? What Sharan Mission Associates is advising to the investors? What we're advising is that now 77.40, 77.80 for Nifty level is the mean. Maximum selling in Nifty will happen up to the level of the 6767 level. Okay, right? And on the upside, up to market might go up to the level of 8700, 9000. If bulls or bears try to take it down or up, there will be immediate buying or selling. So market will remain in this 200 points between 6767 and 8700, 9000 level for they have already discounted 2.5% GDP. They have already discounted 30,000 odd cases of COVID-19. Okay, these things have already been discounted. If there's a negative surprise or a positive surprise, obviously there will either be an upside breakout or a downside breakout. I have already discussed that if market reaches a level of 6,700, it will reach up to the level of 2016 level. At 6,200, it will go down up to level of 2013 level. So all the last 7 years GDP will be wiped off, kind of. Okay. Obviously, we are in uncharted territory, so anything can happen. We nobody can analyze what's going to happen. Only we have to buy the right stocks, fundamentally good stocks at the right price. Because whenever there will be recovery, that will be very sharp. There will be upper circuits in Nifty, and no investor will get the opportunity to buy. Okay, so better buy at the right price. Okay, and stay invested. Okay, so every sort of downside is limited. So what we have to do is that we have to stay put in the right stocks. Now, what is the upside? Say, for example, there's GDP growth. Suddenly, after the lockdown, all sort of sectors start working. Then we might see Nifty trading in the range of 10,030 to 11,040, 11,285. We should not expect markets making new highs. Very unlikely that markets will make new highs. So what will happen is that good stocks will only run, the whole market will not run. Bad stocks will not run. So if you are investor, if you are investing into stocks or mutual fund, don't think that you will buy at 8,700, 9,000 and you will make money. You're not going to make money. You have to buy really cheap. You have to either buy at the 7740 level or below that. Okay, and you have to ensure that you earn profits out of that. Okay, volatility whichever way will be very high. All your investment advisor will keep coming and saying, boss, stay away from market for next 6 months. Now it's totally your call what you have to do. Okay, so this is a discussion which we wanted to do. I hope that we have made some sense. Okay, for the investors, we wish all our investors and all the people who are on this webinar. Obviously, we could not time it well. Today was Mr. Modi's and Man Ki Baat. So there were some 72 odd registered participants. I don't think that they have all participated. So that's why I'm trying to record this video and upload it on social media channels and websites. So thank you. Thanks for being a part of this webinar. Take care.